What's up, investing aliens? Eric here, Mr. Fired Up Wealth. I've got a stock market update for you today. It's been a crazy week or so, especially the last few days. So I'm going to bring you up to speed of what's going on with the market from a high level, macro, the Fed, interest rates, all that, just really quick. And then I'm going to cover 7 stocks that I own. I'm a shareholder in these companies that have reported earnings recently, and I want to provide just updates and my overall thoughts on these stocks. So right now, the Russell 2K is up 1.71%. So small caps doing well here today. Nasdaq's up about 1.43%, S&P 1.53%, Dow Jones 1.23%. Now the 10-year Treasury has come down significantly from that 5%, hovering right now at about 4.699%. Oil's back at $82, up 2% today. Crypto's been hanging in there. Bitcoin, 34,600. Ethereum down 2% today, just under $1,800. So if you're wondering why the market is green today, yesterday the Fed came out, said we're going to pause, not going to raise rates. And the headline here, Fed keeps rates unchanged. Powell hedges on possible end of tightening campaign. Now, of course, media is going to interpret what they hear different ways because I've seen different headlines. So keep that in mind. Some people could easily make the argument that the Fed might have an excuse to still raise rates. Others think the Fed's done. The key part here, though, is we need rates to come down. We need the Fed to start cutting rates, and that's probably not going to happen for some time. Now, earnings overall have been pretty good, with some companies, of course, better than others and some mixed results. Overall, I'd say the macro maybe is slowing down in some areas, but also more resilient than many would have guessed. We just had some jobs data here recently that was a little bit light, but still pretty strong. And so that's a push-pull dynamic we talk about. You know, if job market's too strong, the Fed's going to want to continue to tighten, raise rates to get that inflation down to 2%. So on one hand, you know, a lighter job market seems good in the sense of the stock market because the Fed's not going to raise rates, but it's a delicate balance because you don't want it to get too bad where we get into a recession. The fear and greed index right now is sitting at fear, a 32. If you look a week ago, fear, a month ago, extreme fear. So the sentiment's actually improved some. And a year ago, we were neutral at 55. Some big moves today in both directions. Shopify up over 20%, up 21.93% today after a strong earnings report. Now, Shopify is up 66.82% year to date. So it's doing, very well. In 2022, this is one of the stocks that we recommended a couple different times as a buy, especially between $30 and $40 a share. I recently had a comment on YouTube about this asking, Shopify, you said you like the stock. What's going on with it? It's been a dog. It's actually doing pretty well, especially in a tough environment. And I mean, really, you zoom the lens out, guys. This is up 2,000% since it went public in 2015. Over the last 5 years, it's still up 308%. So market cap today is sitting around $76 billion. And let's dig into the earnings here just to show you some highlights. So non-GAAP EPS of 24 cents, beat by 10 cents. Revenue, 1.71 billion, beat by 40 million. So a beat on the top and bottom lines. This revenue number is up about 25% year over year. So pretty solid, again, given the economic conditions that we're in. One thing important to note here, so subscription solutions revenue increased 29% to 486 million compared to prior year. Sam, don't make fun of my circle. It's freehand with a mouse. Monthly recurring revenue as of September 30th, 2023 increased by 32% to 141 million. So this is a unique model because it has some subscription, some recurring revenue. It's not like a traditional, SaaS company like, built in the cloud for the cloud, enterprise SaaS, CrowdStrike or Zscaler or something like that, but it does have a nice recurring part of its business. So the headline for Shopify soars after key metrics come in strong ahead of holiday quarter. From the CFO here on the earnings call, our results showcase the durability of our business models. We delivered a compelling combination of both top line growth and profitability, with revenue growing 25% year over year and free cash flow margin reaching 16%. That's what this type of market wants to see. The market does not want to see companies that are burning cash, that aren't profitable, that don't have free cash flow. So this one is definitely trending positively. Some quick highlights here on Shopify. They launched what's called the retail plan, a new pricing plan for brick and mortar businesses selling primarily in person. That includes all Shopify point of sale features. So a lot of people don't realize they're getting more into point of sale. Also expanded availability of Shopify's all-in-one mobile point of sale system that's called POS Go. This is one you might have seen in the headlines. Announced an app integration that allows U.S. merchants using Amazon's fulfillment network the option to add the Buy with Prime app from their app ecosystem. A couple different partnerships here, one with Fair and WPP, and also recognized as a leader in the Gartner Magic Quadrant that we talk about on the channel a lot. This is for digital commerce. And so here it is, the Magic Quadrant for digital commerce. So you see Salesforce at the bottom here, you see completeness of vision, and then here, ability to execute. So Shopify is actually the highest one up in terms of ability to execute for digital commerce. When you look at completeness of vision, Salesforce is further to the right. You also see companies like BigCommerce over here, Adobe, SAP, and others. So I like Shopify long term. It's one of my favorite stocks, especially in the e-commerce space. I think after a 20-25% pop, you have to be careful chasing it. So it's not something I necessarily buy now, but I wanted to provide an update because it's one that we've covered on the channel before and we were buying it at lower levels. Now I'm guessing a lot of people clicked on this video just for this update right here, Palantir. There are a lot of people that are excited about this company. There's obviously a lot of buzz around the company, especially online and social media. Stock's up almost 20% today. In fact, it was up over 20% at one point after earnings. So Palantir's sitting at about a $38 billion market cap. The 52-week low on this stock was $5.92. And this is one we were recommending, especially when it was $8 and less. And we got a lot of heat for it on the channel. Here we are at $17.88. This was never a recommendation to buy on Fired Up Wealth when it was at these levels and higher. So the 52-week high, $20.24, it probably works its way back up to 20. Here's what's going on, why the stock is up. So obviously beat on top and bottom lines, initiates Q4 and raises FY23 outlook. Now you're seeing some earnings reports where the companies are actually beating on the top and bottom lines, and then the stock is down, 10 or 20%, and you're scratching your head going, why is that? A lot of it comes down to guidance. Not only, especially if you're an expensive stock, if you're priced, for perfection, you need to beat on the top and bottom lines, and you need to raise guidance or at least beat guidance. If you lower guidance, you're going to get punished in this environment, because many people think that it's going to actually be worse than maybe what the estimates are coming in at. Adjusted free cash flow for Palantir is $141 million, representing a 25% margin. I think that's important to recognize here. And this growth is 16.8%. So it's solid growth, but we just looked at Shopify and it's actually 25% year over year, just for reference. And here's the headline for Palantir. Palantir surges as guidance tops estimate. Possible S&P inclusion awaits. And this is part of the reason why there's been a lot of buzz around the stock too. Of course, anytime a company gets listed in the S&P 500, it's going to drive the stock higher. Institutions are forced to buy shares if they own, for example, ETFs. If it's an S&P 500 index, it's an ETF, or if it's an institution, or if it's a retirement plan, pension, whatever, more shares are going to have to be gobbled up when a company gets included in the S&P, and it's going to drive the stock price higher. Now, I've shared this on the channel before, but management has really done a clever job of working the numbers with stock-based compensation to get that profitability so they can get included in the S&P 500. And that's not a bad thing for shareholders, but it's something just to understand. And I like this company. I know I've said this before, but we were the first YouTube channel to cover Palantir 6 months before it actually went public. And I've been a bull on it, but never at a price that's too expensive. Now, I'm not perfect, and I certainly have stocks that I buy that are higher, but this is a company I've followed really over the last 10 plus years, understand it very well, understand where it's headed. And it's just not one where we wanted to pay when it was, $20 plus. Now, at this point, it's making more sense at these valuations than it did a couple of years ago, simply because they've improved with some dilution, the stock-based compensation. So the numbers are improving, tracking towards what you want to see from, a profitable company that gets included into the S&P 500. And this is big too. So commercial revenue, 23% lead. We've talked about on the channel, the growth engine for Palantir is going to be in the commercial side. They already have strong relationships and partnerships in the government side, and there's still some growth there, but the massive exponential growth is going to come from the commercial sector. And just the last piece here for reference, ended the period with 181 US commercial customers, and that's up 37% year over year. That's solid. Palantir, quick highlights here, $147 million in GAAP net income. $36 million in GAAP operating income. You see that commercial revenue, $403 million, again up 23% year over year. Adjusted free cash flow, 502 million, up 24% on the free cash flow margin. That's really good. And then adjusted operating income at 538 million, and that margin, adjusted operating margin at 25%. Now, we've covered Palantir on the channel many times. So I know I'm going to get a comment like, well, you should have talked about this, or you should have covered this part. We've covered every inch of Palantir on this channel, multiple videos, tons of due diligence. Go check out some other videos. This is just a quick highlight video today. We're covering several stocks. But Palantir is ranked #1 vendor in 2023 AI data science. And if you remember, there was a short report, I think from the Bear Cave, saying that Palantir isn't a true AI company, but yet they keep winning awards for AI and data science. So, you do the math there. So, of course, AI is a big push for Palantir. They have what they call AIP Con, and this is a list of customers that unveiled their AIP workflows. This is starting to get some traction. It's good to see like Cleveland Clinic and Cisco, JD Power, Intuit, some really big names here, United Airlines, and so on. Now, one thing to point out here, I think this is really important to look at. So 37% year over year US commercial customer count. And that translates into 33% year over year US commercial revenue. But I think there's still some gas left in the tank there because it takes time for a customer to get ramped up. And so I think you might see some pull through heading into the next couple of quarters. I actually think that Palantir could have a couple of very strong earnings reports over the next 2-3 quarters because of this AI. The question is can they sustain it and continue to grow it out? I think they can, but it's something to keep an eye on. And as you've seen, if there's any kind of slowdown, a stock like this is going to get punished. That's just the way it is. But 102 commercial deals closed. That's 65% quarter over quarter. If those deals just closed in the last 3 months, they're not seeing a ton of revenue from those yet. And I think they will start to see that revenue come in soon. So they achieved GAAP operating profitability for the 3rd consecutive quarter. And of course, they want to make sure that they keep doing this because they want to get included in the S&P 500. So US commercial revenue growth, you can see 33%, government growth 10%. I mentioned earlier, the growth engine is going to be in commercial, and AIP is really going to help accelerate that. It's something that's really been pushed harder the last several quarters. And if you're researching this company, it's always been about analytics and artificial intelligence, but with all the buzz and more people becoming aware of it, more customers, wanting to go pursue tools, it's starting to accelerate growth for some of these companies. And if you remember, we talked about top 10 AI stocks to buy for the next decade back in January. Palantir was a stock that we mentioned, and we said it was a top AI company. And you're really starting to see that story unfold. Adjusted gross margins are pretty consistent between 80 and 82%. And this is the adjusted operating income. This one is pretty important. So adjusted operating margin, 29%. So you can see the move upward. You also have that operating income of 163 million. And Palantir continues to invest aggressively in AIP in the US while driving operating leverage at scale. Customer count, this is total, 34% year over year, nice trend. Commercial customer count, 45%. This is going from 228 to 330. I think that number continues to go upward. During this quarter, they closed 80 deals of at least $1 million, 29 which were at least $5 million, and 12 which were at least $10 million. So starting to get some big wins. And Palantir is not going to run out of cash anytime soon. They have $3.3 billion in cash and cash equivalents. I think a lot of people might not realize that. As you guys know, I've been bullish on Palantir since before it went public. I was always excited about this company. I was following it for years. They kept saying they're going to go public and never did. Finally, they did. It was a direct listing. It wasn't an IPO. It was a direct listing. And I remember in Discord, it was a buy $9 or less. And then the stock absolutely ripped. We're like, don't chase it up here. And it's been a roller coaster, but the company has really grown into its pants. And I do think the company will do well long term, but I also think you have to be careful of not paying too much for it. So I know you want me to come on here and say, buy it, it's going to the moon. And it certainly will probably go higher. I think it'll go over $20. I mean, heck, you could see it $25, $30. And I don't have a ton of time in this video to go deep into valuation, but I will tell you that at these price levels, it's getting pretty expensive compared to its peers. This is going to be in the SaaS arena. The one thing to note though is this is one of those profitable names. It has solid free cash flow. It's got, $3.3 billion of cash and so on. And of course, not every name in that sector can say that. And Palantir is also very unique. I mean, there are other companies that can kind of do what they do, but if you look under the hood and you look at the government relationships and so on, it does have a much healthier moat than a lot of other software names if you really dive under the hood. All right, next is Mercado Libre. Ticker is MELI. This one's up, slightly today, up 1.86%. The stock is up 60% year to date, so keep that in mind. Market cap on this is sitting around $66 billion today. 52-week low on this was $8.15. 52-week high was $14.51. So just had earnings last night. Mercado Libre GAAP EPS $7.18, beat by $1.35. That's very strong. Revenue of $3.8 billion, beat by $250 million. So this is year-over-year growth of 41.3%. And I think some people might be surprised by that. They might, if you just listed and I said Shopify, Palantir, and Mercado Libre, which had the strongest year-over-year revenue growth of the three, I think most people wouldn't pick MELI as first. We covered it already, but Shopify, 24.8% year-over-year revenue growth. Palantir, 16.8% year-over-year revenue growth. And then you got Mercado Libre at 41.3% year-over-year. And this is a very healthy company, also has a healthy balance sheet. Let's look a little closer on it. The headline, Mercado Libre smashes quarterly profit estimates on Mexico, Brazil outperformance. Now, we've talked about on the channel how I thought Mexico was going to be huge for MELI, and that's starting to come to fruition as well. This is a stock that I really liked, under $1,000 a share. You could argue that it's not really crazy expensive for what you get in the growth metrics. If you look at the free cash flow and the positive momentum for the company, there are a lot of good things about it. And it's easy to make a bear case and say, well, it's risky because you've got the macro and geopolitical risks of Latin America and high inflation, yet they keep crushing it consistently quarter over quarter. MELI touted the effect of relaunching its loyalty program during the quarter, which the e-commerce firm kicked off in Brazil and Mexico late August through marketing campaigns. The revamped bundle reduced the threshold of free shipping, and this goes down to $29 in the local currency from $79, so a significant drop. Also said its investments into logistics in Q3 helped it hit a record level of fulfillment operations of 48% of shipments. Now, we talk a lot about Tesla in this recent quarter. Tesla investing more capital because it wants to grow. And short term, it's a negative, but then longer term, you see the results. This is something where obviously they had to spend some money, invest in the logistics, and then there's, dividends that pay off down the road from that, benefits from that. So MELI saw a 27% year-over-year acceleration in items sold in Brazil, which was the highest rate of growth in that country since Q4 of 2021. And then fintech revenue showed signs of resurgence in Q3, rising 33% year over year and improving from Q2's gain of 24%. It was one of the hardest things as a growth investor is trying to understand how to put a valuation on a company. And, there are lots of different types of investors out there. There's nothing wrong with, say, a value investor, but it's very hard for a value investor to reap those huge gains if you're focused on, I only buy a 12 PE or a 15 PE. Certain companies are going to trade at certain valuations for certain reasons. And like with this stock, you can look at the non-GAAP TTM PE 66. The forward PE gap is 67.37. So depending on how you look at this, you could say, well, this is not a very cheap stock. This is something that would have to come down to a 20 P ratio before I would ever buy it. Well, maybe it happens. It's always possible. But this is one of those stocks that you really have to measure this one a little bit differently. Number one, with the total addressable market and just the growth metrics, the possible SAM. Again, this is a $66 billion market cap. And so if this were a $1 trillion company, it's a different story, but at $66 billion, you can look at it and say, well, if you look at the total addressable market, there's massive amounts of total addressable market across Latin America, and they're developing this infrastructure and logistics that's very hard. It creates barriers of entry for other competition. Even Amazon struggled in certain areas trying to compete against Mercado Libre. Now, what's funny about it, people will say Mercado Libre, the next Amazon, it's the Amazon of Latin America. Mercado Libre is a good company, but it can never be Amazon because it doesn't have cloud services. Amazon is unique because of AWS. And fun fact, the majority of Mercado Libre's business is run on Amazon Web Services. Now, see, you look at the growth metrics on MELI, and it's an A+ here. This is on Seeking Alpha. And you start looking at year-over-year growth. You start looking at, different things like GAAP growth forward, 156%. EPS GAAP growth, 470.66%. I'm not sure if these are updated since earnings, but you get the idea. Also strong profitability. Gross profit margin here is at 56%. So I'm not trying to paint the picture that it's dirt cheap or anything like that. I'm just saying it's very hard if you're trying to capture growth to find stocks that are going to be what's, classified as value investing. Not that you can't make money value investing, but if you're going for pure alpha, a stock like this is just really hard. You're not going to get it at the price you probably want it at. Up next, let's talk about Confluent. So non-GAAP EPS, 2 cents, it beat by 3 cents. Revenue, 200.18 million, beat by 5.01 million. So at first glance, you look at this and say, hey, it doesn't seem so bad. Beat on top and bottom lines, revenue growth of 31.9%, doing better than a couple other names we talked about today. So here's where it starts to get messy. This does not have the financial strength or the balance sheet of some of the other companies we've talked about. In this type of environment, if you're burning cash, you're not profitable, you show a slowdown in growth, you're going to get slaughtered. The market right now, because of fear, wants to put money into companies that have strong balance sheets, that positive free cash flow. The market really wants to purge itself from more speculative names, unprofitable names. You get the idea. So hear me say this. You're going to see more stocks like this get slaughtered during earnings season if something comes in not quite right. Even a slight miss or slight guidance or something said on the earnings call can set off analysts and the market itself, and you can see these stocks drop really hard. So the headline, Confluent tumbles 33% after Bank of America downgrades on disappointing outlook. Let's dig into this. So the analyst said that Confluent reported disappointing remaining performance obligations, and I agree with this. RPO, it decelerated 24% from 34%. So this is remaining performance obligation. And this is showing signs of weakness from incremental macro pressure and an accelerated sales incentive transition plan to cloud consumption deals. Now, I worked at Oracle when we went through the exact same transition and I was in sales. Okay, this is open source, so it's not tier one. Tier one, we put in stocks like a CrowdStrike, a Zscaler, those type of names are higher quality. Those were IPOs before the pandemic. They're also true SaaS models built in the cloud for the cloud. Fully recurring revenue, high margins. This is a very different stock. So this is something that's open source. It's going to be more bolt-on, more on-prem, more consulting services, lower margin profile. And what the company is trying to do, like a lot of these names that are in that open source space, they're essentially building cloud tools, so versions. So Confluent is one example. HCP is another, and so on. MongoDB would be in that list. What they're doing is they're trying to convince their salespeople to get their customers to go to cloud. And the reason for it, it's got that recurring revenue. They're focused on ARR, annual recurring revenue. So it's going to cost more money to pay these salespeople to get this done. Short-term pain, probably longer-term gain, but I will share my thoughts on this one here in a second, so just hold on. So cloud net retention rate declined to 130% from 140%. Now 130% is not a bad number, but a decline of 10%, in Q2 is significant. Essentially, they have some higher concentration in a couple customers. There's also some Israel risk. We could go down a whole rabbit hole here. We've talked a lot about it in Discord. If you guys are not in our Discord, I'm serious, you need to join. Just give it a try. There's actually a free trial right now. You can go check it out and get a free week and just see what it's all about, because we're talking about stuff like this last night and this morning, way before you're getting the information on YouTube. So the analysts expect this to weigh on growth for at least a full year. And so going back to this headwind, so one of their customers actually migrated back onto on-premise. Now, sometimes there are business reasons for that, and you'd really have to have a lot more information, but either way, it's going to be bad for analysts and for the market. It's basically sending you a signal, or analysts a signal, or Wall Street a signal that, hey, maybe this tool isn't so great. People are going to ditch it and actually go back to on-prem. Maybe this isn't so cool after all. But there could be very valid reasons for it. We talk about hybrid clouds. Certain companies are going to operate better with a hybrid or even an on-prem environment. And that's really going to be the minority. It's not the majority by any means, but every customer is going to be unique when you think of cloud. And this is what my previous job is to try to find solutions for specific pain points. And every client was different. Just like every portfolio, every investor watching this video, you have a different portfolio based off of your needs, your risk tolerance, your suitability, and so on. So they also added that there are several other headwinds impacting near-term growth. They noted Confluent is not alone in the company of software firms experiencing macro pressure. However, the magnitude of incremental impact on growth, FY24 outlook for 22%, compared to Bank of America's 28% is due to several other company-specific items. So this is saying there is some macro pressure out there that's putting some pressure on specific cloud-related names, but a lot of this pain is Confluent specific. All right, so this is big. So first, Confluent has outsized exposure to Israel, a top 10 country by revenue contribution. So a top 10 country by revenue contribution, well, of course, they're at war right now. That creates a lot of uncertainty. Wall Street hates uncertainty. Companies have also obviously pulled back on discretionary spend. Makes sense. Secondly, we kind of talked about this earlier. The company is accelerating the transition to a sales compensation model, which aligns to go-to-market operations with underlying consumptions and prioritizes new workload adoption over upfront bookings. And this is the big one. And this is big too. There's limited visibility for timing of reacceleration or profitability. There's no path to profitability. There's no clear signs or catalysts that revenue is going to accelerate again. Wall Street's going to dump a stock like that hard. It's going to be in the doghouse for a while. Eventually, if the company starts to prove itself, it will come back, but it's going to take some time. My thoughts on Confluent, it is an interesting company. I think what they do is very interesting. I think there's opportunity longer term. The company was really founded in 2014, so it's been around less than 10 years. It's tough with the open source model to kind of grow and to convert, I think, into that cloud type model. Now, if you look back at a company like MongoDB, now, of course, the reason that's popped is that AI buzz. And, this company doesn't have that same AI buzz around it. But MongoDB did go through some growing pains as well. And it's a very different company, but just going from like that open source to selling a version in the cloud. So for me personally, it's not a stock that I would recommend you go buy hand over fist. I think it could be in the doghouse for a while. I think there are better stocks to put your money, but at the same time, I do think the company will recover with time. But there are a tremendous amount of risks, and we covered those from a high level the best we could on a short video. The reality is that you cannot always foresee what's going to happen. I mean, you can do 1,000 hours of due diligence, understand the company inside and out, but you can't predict, a war in Israel. You can't predict this or that. I think what's interesting about the company it was just starting to get some buzz on Wall Street here this year. I think Wall Street was trying to look for names that were outside of those mega cap tech type companies. And I was seeing it get covered more and more, buy ratings coming out when the stock was much higher and so on. And this is one we have in the community portfolio. And, of course, it was green. It was up 25% or something going into earnings, and now it's down. Now, originally what it did is it basically gave up the year-to-date gains, but it has taken a leg lower since. And here's the chart. It's pretty nasty. It was trying to hold up here on the support line. I mean, it was around $26 for earnings, and this is a huge gap down, trading now at $15.60. So if you look at this is a massive gap, and it's going to take some time to fill that. This is not something that's probably going to just bounce overnight and come back to these levels. It's probably going to pop up and then fade a little bit more. The bottom of this retracement is something like 1267. And you look at that and say, there's no way it's going to go from, it was a $40 stock up here, $41, and it's going to go from 41 to 12. Trust me, anything can happen. A stock can always go lower. The bottom is always zero. You look at some of these charts and they're down, 75%, and you think maybe it's a good opportunity, and it drops 50% from 75. If a stock's $400 and it's down huge to we talk about like Upstart, like a $400 stock, and it gets to 100, you think, well, that's a pretty good deal. And then it goes to $12. A stock can always go lower. So the sentiment's awful for this stock. If you're buying it, I think you have to buy it really as more of a speculative investment at this point. I mean, the story has changed, and it happens. As an investor, you're going to invest in quality companies. This is why, like, when I invest in stocks, I don't like to have just 3 or 4 names in high concentrations, because things that you can't necessarily predict will happen. And in this kind of environment, this is a perfect storm for a stock like this to get taken to the woodshed. And so what it really tried to do, it actually got halted this morning. It kind of started to see some buyers in the pre-market, right around the 1660s. This was a double bottom. So this goes back to May 2022. This is January 2023. So really a double bottom around $16.50, and it ripped up to $41. Of course, the charts aren't going to tell you anything if there's a huge macro issue or a huge issue with the company earnings and so on. So analysts are seeing not only that the company's slowing down, but there are fundamental risk with the business itself and some deterioration. I personally think that this company will figure it out. I think it'll be fine long term. With that said, I also understand how Wall Street is, and this isn't going to be fashionable anytime soon. So definitely keep it in mind. It's just going to take some time for this to recover, and it's going to have to prove itself, honestly. But I wouldn't necessarily say that it's a buy for every person, every portfolio, every risk tolerance. It's going to be very unique to the person. And this is one of those companies that could just be in the doghouse for a while until rates start going the other direction. So this could trade, sideways to lower for a good 6 months or even a year. It's very possible. So looking at the stock, it's down 27% year to date. So obviously that is significant. But if you bought the top in July at $40, you're crushed much more. The stock's down 30% over the past year. And if you look at the 1-day chart, it's down 45%. So obviously that's a dramatic move and it gets lots of attention, and I'm not discounting it whatsoever, but it is important to note that it did run up to $40 and gave it back. So it started the year, it was actually at one point lower. It's using 21.33 here, January 3rd. But it actually dropped from 21.33 down to 17.93. So it's trading, roughly $2.30 lower than the lowest point we saw this year. I think that's good for perspective, and I'm not trying to defend it, but people always talk about the extremes. Well, of course, if you bought the top, but nobody I know was buying it at $40 a share in 2022. I mean, you look back to May, it was $18.91, so, and now it's, roughly $15.63. And I think it could go lower. But the point is, if you bought it at $18, $19, it obviously hurts, but not as bad as if you bought it at $93.60 back November of 2021, or even when it was, $40 early this year. Wingstop, another Fired Up Wealth winner. This is one that I've covered that I don't see a lot of coverage elsewhere. I really like this company a lot. I have a restaurant background, and I generally don't like investing in restaurant stocks. We do own a little bit of Texas Roadhouse and the community portfolio, and then Wingstop. I think I just own it in my main portfolio. Now, this stock at one point was down, I think $70 or something in 2022. It's back around $200 a share. I mean, this is a Wingstop. This is Wingstop. We're talking about wings here, restaurant. 26.4% year-over-year growth. This is growing at, faster than a lot of software companies. And it's profitable. It pays a dividend. It's a DGIF stock. So Q4 GAAP EPS 69 cents, beat by 17 cents. Revenue of 117 million, 117.1 million, beat by 8 million, up 26.4% year-over-year. Domestic same-store sales increased 15.3%. That's a really strong number right there. Digital sales increased to 66.9%. And this is really where they've thrived. A lot of digital orders. It's made the company efficient. It's made the labor costs lower. If you look at even the storefronts, they're not like massive restaurants like Buffalo Wild Wings where they have to spend a ton of money having the big restaurant style. They're kind of these small shops that aren't really that expensive to build. Lots of digital orders, DoorDash, or people coming to pick up orders and so on. So this stock, believe it or not, is up 48.63%. So this is up more than a lot of the high tech names that you're probably excited about. And of course, nobody wants to talk about it because it's wings, but I'm telling you guys, this is one I really like. Now, it's 86 PE ratio right now. So at $198, I'm not saying I'd go buy it hand over fist or anything like this or anything like that. But what I'm saying is this is one that we've been buying in the community at much lower levels, and I'm excited about the long-term future of it. It's completely ripped from $73 to $200 in that time. And you actually can see here, it got to $200 and then faded, sold off to $158, and then it's kind of back to that $200 range. So if it can break that $200, it's probably going to get resistance. You probably see it go up to $225, something like that. That's the 52-week high, actually, $223.77. It pays a nice little dividend. It's not a huge dividend, 0.44% dividend yield, so it's what I'd call a DGIF stock. And it's up 218% in the last 5 years, 583% all time since 2015. This is one where they pay a special dividend once in a while. I think it's a good company. I don't think you should go buy it at $200 a share, but it's one to put on your watch list. Airbnb, the free cash flow machine. So this one was actually down slightly today. Let's just look at the chart really fast. If my voice is starting to cut out, forgive me. I've been struggling with this voice, and it's really hard to make this video because my voice will cut out and I'll have to redo the scene, but I'm fighting through it, guys. Airbnb at $116. So it's down, 2.69%. It is up about 37% year to date, though. So I mean, it's all relative. People say, oh, why is this stock down 5% or 2% today? With the exception of one stock we talked about today, these stocks have ripped, year to date. And all 7 of the companies that we're talking about today, I am a shareholder of. So Airbnb up 37% year to date, down slightly today off earnings. This is sitting probably around 30 PE ratio on today's information after earnings. Market cap $75 billion. So the Q3 GAAP EPS, it's important. This is actually GAAP EPS. So many of these are non-GAAP, and it's like, well, give me the GAAP. GAAP EPS of $6.63 beat by $4.53. So GAAP EPS of $6.63. The estimate was way lower than that, beat by $4.53. That's a massive beat. And you think, well, wait a minute, why isn't the stock higher, with a massive beat like that? Revenue, $3.4 billion, beat by $30 million, and that's up 18% year over year. So not bad, but one of the lower ones that we've looked at today. And here's why it's down. Headline, Airbnb falls after warning the economy volatility is dampening travel demand. So the economy being volatile, the stock market being volatile, people losing jobs, just uncertainty with the overall macro conditions. People are going to spend less money. They have less money to spend because student loans came back in, interest rates are higher, inflation, et cetera, et cetera. People are going to spend less money on travel. Plus, a lot of people got that pandemic travel bug out of their system. So maybe there's some slowing down there. A lot of people were, work from anywhere. That trend has kind of slowed down some too. I think Airbnb is a good company longer term, but it's going to be very cyclical and it's going to ride the waves of the economy. So if you own this stock, it's one that you have to be aware that it's going to ride the waves. And $115, most of the buys I've recommended on Airbnb, $105 or less. I've said before, if you really like it, maybe $115 or less, but $105 or less has really been my preference on Airbnb and not to overpay for it. Now, every time they report earnings, though, the stock is actually getting a little bit less expensive. It's not necessarily a cheap stock, but it's very profitable. It has some very strong metrics there, free cash flow, cash on hand, and so on. So it's what I'd consider a very high quality company. I mean, there are always going to be risks with any stock. For example, competition, VRBO or Verbo, and you've talked about Hilton and Marriott and others trying to come in the space. But as of right now, it's a verb. It's a verb where you say, I'm going to Airbnb it. But you have to be careful of that too, because I remember in the past things like, Zillow is a verb, but yet it doesn't matter. The stock has done, very poorly over the last several years. So you have to be careful with that. But that said, looking at the actual financials, this is a strong business. So it's like comparing apples to oranges, but you get my drift. Revenue though, $3.4 billion. This is the one I want to show you. Free cash flow. We generated $1.3 billion of both net cash provided by operating activities and free cash flow in Q3. Our 12 months trailing free cash flow was a record $4.2 billion. Essentially, they create this app. They don't have a ton of overhead or expenses, R&D, and it's a cash cow. It's bringing in a ton of, some great money. Free cash flow margin, 42%, 44% actually. But again, as the economy slows down, travel is going to slow. You're going to have peaks and valleys with a stock like this. I think if it gets to $105 or less, it's something to look at. The last stock I want to cover is Amazon. There's a key piece of news I want to share. This one's up 60.36% year to date. This is one that I was really heavy on last year, talking about tier one. Add the names like Microsoft, Amazon, Google, Apple. And if you're going, the next tier after that, CrowdStrike, Zscaler, names like that. Even Tesla was one, and NVIDIA and AMD, those were all names that we were big on in 2022, trying to accumulate those shares while we thought they were attractive levels. This is one where it's like, what do I do with Amazon? People say, should I buy Amazon? I mean, the 52-week low was $81. Now it's $137. It's really hard. I mean, is it going to be worth more in 5 years? I think there's a good chance of that. It's one of the top holdings, one of the core holdings in my portfolio. But where do you buy it? It's really tough. It's a $1.42 trillion market cap. It's showing here in Google a 71 PE ratio. It's just a really tough company to get into. This is one I've been in for a while. My best advice would have been to, buy it when it was under $100 last year, which I was saying on YouTube over and over. If you're new to the market, you have to decide what you want to pay. And it can be really tough. It really can. And that goes really for all the mega cap tech names. If you miss the lows, it's really tough. And those are the ones that we tried to focus on last year. But my voice is given out. This is a real quick piece here to wrap it up. Amazon unveils buy now, pay later option from a firm for small business owners. I don't own a firm. I do own Amazon. I think it's something, important just to point out to you guys on this video. Definitely read up more about it. There are plenty of articles online. If you're new here, please do me a favor and subscribe to the channel. Click that bell for notifications. If this video is helpful, drop me a like, drop me a comment. Thanks for watching, guys. Have a great rest of your day. Take care.